What is going on, YouTube? Welcome to the Living Free channel. My name is Tyler Freed, and in this video, I'm going to be talking about having a payback plan for your trucking business, having a payback plan for all the money that you plan on investing into your trucking business, whether that is one truck, two trucks, multiple trucks, does not matter, trailers, all the money that you plan on investing into your trucking business startup. You do need to have a payback plan and a guaranteed rate of return that you pay yourself for whatever money, personal money, that you put into the business. This is going to apply to you whether or not, again, you finance the vehicles that you buy. You do use banks to finance your vehicles, or you pay cash. Why am I making this video? Well, because I did get a comment on one of my recent videos where I did a cost per mile video and a cost per day video, and I believe it was the cost per mile video. And as you can see, there is a set of numbers over here that I have laid out, and these numbers I had in the cost per mile and cost per day video. And as you can see, I have my fixed expenses, variable expenses. These are not exact expenses for any of my trucks or anybody else's trucks. It's just an example to illustrate the point as to how to calculate cost per mile and cost per day. Well, anyway, on here I left out a truck payment, and the reason I did that is because I always advise anybody who wants to become an owner-operator to pay cash for their vehicles. And because I said that, somebody did say, well, even if you pay cash, isn't there still a payment that you have to make back to yourself for all the money that you put into that truck? And the answer to that is actually true. Yes, even if you pay cash, yes, you are loaning yourself that money to start that business. So think about it. If you want to pay, think about if it's going to cost you $75,000 to buy your first truck. Well, you could put that money into a low-cost S&P 500 index or a total world stock market index and make 10% a year on your money without having to do any work. It's just a passive investment. You invest it, you set it and forget it and hold on to it, and you don't have to do anything. Or you could put it in even lower risk investment like U.S. Treasury or money market, and I'm going to show you all those examples. And so instead of putting it into a more high-risk investment, which that is a business is more high risk than like a broad low-cost index fund or, like I said, a U.S. Treasury or money market, something with very low risk, because most businesses fail. That is the truth. However, just because 90% of businesses fail does not mean that you can't be part of that 10% that do succeed. And when you are part of that 10% that do succeed, the returns of owning your own business can be absolutely amazing. But it is true, you do need to have a payback plan, at least a minimum rate of return that you are making on your money. That and what I use as my discounted cash flow method is 10% a year. And the reason I do that, and most investors don't, they'll use like the Fed funds rate to do that. They'll use U.S. Treasuries to do that. So right now, I believe I have it pulled up. Let's see here. The Fed fund rate today is 4 to 4.25%. So right now, as you can see here on this site, hold on a second. As you can see here, if you buy a 3-month government treasury bond, it's yielding about 3.84%, and the 10 years yielding about 4%. So depending on the duration as to however long you plan on investing in any of these particular bonds, you can make risk-free pretty much by just buying a short-term treasury. You can make 3.84%. So if you have that $75,000 and you buy short-term treasuries, like I said, you're pretty much making 3.75%, close to 4% on your money without any risk. Or you can do, like I said, the S&P 500 over the last 20 years has averaged 9 to 11% 10% over the last 20 years. And so I like to use 10% a year, again, because I personally, other than trucking, I invest in a low-cost index fund or low-cost index funds. I buy the total world stock market, not just the S&P 500, and but they have tracked very closely. They've both pretty much averaged about 10% per year over the last 40, 50, 60 years, and that's what I use. But you just got to determine, okay, what could I put my money in instead of this business, and what's the risk reward? It's very simple. And how does that factor into my cost of operation while running my business? By the way, this example really applies to any business, but I'm using trucking as the example because that's what I do. That's the business I run. But if I were investing in any business, I would want a loan payment, even if I were paying cash for the whole thing, the whole startup. I want a payback plan back to myself at a very good interest rate so that I guarantee I get my money back, number one, and number two, I get it with the interest that I could be earning on that money without the risk of running a business. It's very simple. So as you can see, I have a line of credit calculator pulled up. This is the first thing you need to know. Well, one, again, you need to know, okay, what could I have my money invested in, as I just alluded to. I could invest in treasuries, a money market, or the stock market, whatever, or real estate. But real estate's an active business. I would actually do the same thing with real estate. It's a little different than starting like an actual business, but you could have your money in real estate instead. You could take that 75K, go put money down on a rental property and make 10-15% a year on your money. So this will determine whether that business that you want to start is even worth starting, actually, because a lot of you may look at the payment back to yourself like, man, I don't know if it's worth it or not. But that's why you need to run these numbers and pretty much guarantee that you can pay yourself back what I'm about to show you. So like I said, I'm going to use $75,000 as the example. Okay, so let's say you just want to buy one truck, you want to become an owner-operator, and you're just going to start with one truck. And let's say you're going to buy this truck and you're going to keep it for 3 years. You're going to buy it and you're going to pay yourself back over 3 years. And I'm going to use 10%, like I said, because that's what I would pay myself back. That's what I do with every one of my trucks. I have a 10% interest payment over 3 years back to myself. So let's say you're paying $75,000 for 3 years at 10% monthly payment. That's the frequency of how when you pay. Okay, so as you can see, it is $2,420. So pretty much $2,400 a month in this example. Some of you are buying trucks that they cost $100,000 or $120,000, whatever you put. And however long you plan on keeping that truck, though, is the duration at which you want to pay yourself back. Okay, so if you plan on keeping it for 5 years, you do it over 5 years. If you plan on keeping it for 2, you do it over 2. Moral of the story is you need to have a payback plan for however long you plan on keeping the truck. It's that simple. And so and if you are not paying cash, like I said, let's say that's your down payment. That's what you need to pay yourself back every month, plus the payment that you're making to the bank. So whatever you put down on a truck, that's your money. That's your principal that you need to pay yourself back. And you need to have a payback plan, of course, for the bank that lends you the money, but also yourself for the money you put down. Moral of the story, you get the point. I keep saying it over and over again because it's important to understand that you need to have a plan to do this. And so what do you see here? Okay, so for $75,000 at 10% interest paid back over 36 months, $2,420 a month. So what we're going to do is we're going to pull up this calculator. 2,420 times 12 times 3 years, and that's how much money you're paying yourself back. $87,120. And what I would do being that, it is a truck. Let's say, at the end of it, you can get $20,000. So you paid 75, but at the end of it, you could get about $20,000 for that truck, right? You want to add that to all the money you paid yourself back, plus the sale price. So this is how much money you've really made: 107,000 over 3 years. So you invested 75, you made 107 total. But you have to factor in replacing the truck. I've been asked about that before. What's your plan on, replacing the truck? Do you rebuild the engine, or do you just sell it and buy another truck? That'll depend on the truck, honestly. Some trucks, I may keep them and just run them until they need a rebuild. Other trucks may have too many problems, and once that warranty expires, I may want to trade that truck in and just get a newer one. It just depends, honestly. My first truck I bought, it wasn't great the first 5 or 6 months, but now it runs like a champ, and I'm considering just holding on to that truck when the warranty expires and rebuilding the engine, because a rebuild's probably about, at least half the price of a newer truck that I would buy. Maybe a little more, maybe like 60% of the value of a newer truck to rebuild the engine. So I might do that instead, or I might not. It'll just depend. Moral of the story, though, is again, you still need to run these numbers. What I'm doing right now is just showing you the things you need to think about when you plan on investing money into anything. You need to think about these scenarios, okay? So in this example, like I said, you bought your first truck, you paid yourself back the $2,400 a month over 3 years at 10% interest plus the sale of the asset, and I did $20,000. You may be able to get a little more than that. If you take great care of your truck and it's in great condition, you may be able to sell it for $25,000, $30,000. It just depends, right? So, but you do got to replace that truck if you plan on selling it and getting another truck. So you want to, subtract what another truck would cost you, and that's how much you've made. $32,000 over 3 years, right? But think about it. You're like, oh, okay, well, what was the point in paying 75 to make 30 over 3 years? And if I divide that by 3, you made $10,706 a year. Truly. Well, you still own that asset, right? The moral, you need to have a plan, again, to pay yourself back and keep that asset at the end of the deal, and profit on top of that. And how do you calculate your return, right? Well, it was about $30,000 a year, or $30,000 over 3 years is what you profited in this example. And this is assuming that you don't make more than the minimum payment. This is why I do a payback plan, because if I at least make the minimum payment over 3 years, I will at least have made pretty much 50% of my money. $32,000, that's pretty much 50% on my money over 3 years, right? And you take that 32,000 divided by 3, that gives you the yearly return over 3 years, and then you divide that by the purchase price, 75,000, and my average rate of return is 14%. And that's if I make the minimum payment, sell the truck for $20,000, and I don't make any more money than the minimum payment back to myself. Why do I look at this? Because it's like, okay, well, if I can stick my money in an index fund and make 10%, I at least need to beat that. I at least need to beat 10%. Really, I want to make like 25% on my money to take this big of a risk and deal with this much headache of running my own business. I want to at least, of course, beat the S&P 500 or Total World Stock Market Index, but I want to honestly crush it by at least 10%, but in this example, as you can see, that's a 14% rate of return if I just make the minimum payment and the sale of the truck. So it is a guaranteed rate of return. It is 100%. But like I said, you should make more than that. That's only $600 a week in true profit. And if you're driving, if you're driving the truck yourself and not hiring a driver, I mean, you could probably pay yourself back in a year and a half, to be honest with you. But I'm doing numbers based on hiring a driver. Even if I was driving, what's the true profit? Can I make this payment or profit more than this payment over 3 years? And pay myself what I could make as a company driver. And I talk a lot about that in other videos. But moral of the story, as you can see, these are the type of numbers I run. No matter how much money I'm putting in, this could be, $400,000. Okay, what's 400,000 divided by 3 years at 10% interest? And if that 400,000 buys me, 4 or 5 trucks, those 4 or 5 trucks have to be able to make those payments plus the interest. And then, I have to factor in the sale of the vehicle at the end of it, or factor in potentially rebuilding the engine. And if you rebuild the engine, that's another long-term investment. If you decide to say, okay, I'm going to take 40 grand and rebuild the engine. Okay, how long will that rebuild last you? You need to have a payback plan for that. Moral of the story is you just need to know your numbers. You need to know your numbers inside and out when running your own business. So what I'm going to do here is I'm going to pull up the cost per mile calculator and use this as an example. Okay, so your truck payment to yourself now is 2,400. Okay, I just did 2,400 to make it simple. All right, so what you do in this example right here for cost per mile, I use 10,000 miles, okay, as the example. Here's the fixed costs, so truck payment, insurance, ELD, any fixed costs, payments that don't change. Truck payments don't change, insurance doesn't change, ELD, any fixed costs, that's what I put on here as the example over 10,000 miles. So I have 9,590 down here at the bottom, and that's without the truck payment. So all I got to do is take the 9,590 plus the 2,400 a month in truck payments. So now that's my fixed cost. If I include the truck payment back to myself, divide that by 10,000, and it's $1.19. So pretty much $1.20. So it added 24 cents a mile. And then down here, my variable costs, I pretty much did the fuel and the maintenance. And of course, you have things like tolls and, supplies and stuff like that. But I'm just doing this, like I said, as an example to illustrate the point. But these are variable costs: fuel, maintenance, supplies, tolls, things like that. In this example, using 10,000 miles, right? I did 10,000 miles divided by 7 miles per gallon. That gave me 1428 gallons that I have to buy over the course of 10,000 miles, times $3 a gallon gave me 42.85. And then I did factor in on this a 15 cent per mile charge to the maintenance account. So over 10,000 miles, that's $1,500. And combining these two things, that pretty much came out to 58 cents a mile. So I'll just add the 58 to it. And this is what you need to run for. This would be your break-even number right here, $1.78 per mile over 10,000 miles. I'll do the cost per day in a second because it's very easy to do that as well. But this is what you need to do. You can't take a load if you're going to pay yourself back. Even if you pay cash, if you're going to pay yourself back for the money that you put into that truck. In this example, now I do have insurance at $1,800. A lot of you, and that's 18 cents a mile right there. A lot of you are leased on to carriers where your insurance isn't going to cost anywhere near that amount. So just to be clear, these numbers are just hypothetical, again, to illustrate the point and to just teach how to run these numbers, right? You got to do these numbers for yourself. If you're a business owner in trucking, you got to do these numbers for yourself. So again, in this example though, if you're running for $1.78, anything above that is pure profit. So let's say, your cost is $1.78 and you're averaging $1.90 times 10,000 miles, right? That's 19,000 a month. And then it'd be what, 17.8 So what you would do is subtract the two. So your true profit a week is 1,200, or a month is 1,200, and a week it's 300, right? And here's what I'm going to do here. I'm going to show you something. So let's say you make, you're doing $1.90 on average, and your cost is $1.78. This is your true profit above the truck payment back to yourself. Remember, as I showed you, doing a 10% interest rate back to yourself over 3 years is you're paying yourself back that $2,400 a month. Plus, if you profit this right here, you do that times 12. That's an extra 14,000 a year. You do that times 3. That's $43,000, right? And I remember in the example, okay, it was like you made like $32,000 just paying yourself back the minimum truck payment, and that was it, in the sale of the truck. Well, if you add in the extra profit you make above the truck payment back to yourself, which is what you want to do to get the real return, as you can see, that's you made 100% of your money back, 100%, right? And you bought the truck back, or you cycled out that truck and bought another one. So you'll take that 75 divided by 3. That's 25,000 a year. If you include the extra money, the extra profit that you made above the payment back to yourself, divided by 75. So here's your real return, 33% a year. 33% a year. So I knew a lot of you, I probably lost a lot of you about a trucking business earlier when I was like, hey, you can make about 14% of your money on your money. Again, that's only if you make the minimum payment. But as I just showed you in this example, if you make $1.90 a mile and your costs are $1.79, and you make that minimum, that's including the payback to yourself plus the 10% interest and the sale of the truck at the end, and you buy another truck. The return on your 75,000 in this example over 3 years is 33% a year. That's pretty good. That's pretty good. That is destroying the S&P 500. It's definitely destroying like U.S. Treasuries and things like that. And what would I want to do with that? I would want to go to an investment calculator. And I was running numbers before this video, but I'm going to show you. Let's say, okay, you're 25, and you want to buy this truck. It's going to cost you 75,000. Right? And you're going to contribute nothing, and your annual return will be 33%. So your 75 will turn into $199,000. That's how much money you will make. Okay, of course you have to sell, you have to buy the truck, repurchase another truck. So, but when you do that, you still own this asset that's making you 30% a year. Or even if you're making 20% a year. If you're making, in a business, in my opinion, if you're making like 15% minimum, that's not great. If you're making 20% or more in your business, you're doing very well. And that's including paying yourself your salary that you could be making at a job. That's a lot better than owning an S&P 500 index, because let's say you only get 10% for 3 years. Okay, your 75 turns into 101, right? Big difference from, 30%. 182, as you can see. And if you do that over, let's say you do that over 10 years, that's 1.4 million if you're averaging 30% a year. Shoot, even if you're averaging just 20% a year on your money, 545, your 75K turns into 500,000. And again, you're factoring in, of course, you got to factor in rebuying the trucks a few times. But when you own these assets, they cash flow, and they cash flow enough to not only pay yourself back that money at a good interest rate, but replace the vehicle and get a very high yield on your money. And of course, you have to succeed at getting those rates. You have to, have the money to be able to pay cash for a truck. And if you put money down on a truck, it's going to cost you a lot more than, just paying yourself back, right? Because you got to factor in paying yourself back the money you put in, and paying the bank back. See, but I still recommend, even though I have a payback plan back to myself, I still recommend doing it cash. Why? Because if we go into a recession, if my trucks are in the shop a lot and they're costing me a lot of money in repairs and downtime, there's no mandate that I have to pay myself back. There's not. If I don't pay myself back, my trucks won't get repossessed. If I don't pay the bank back, though, I could go bankrupt. It's very simple. Of course, numbers can work out. When you run a business, whether you're doing it debt free or not debt free, if you use leverage, of course, you can still be very profitable and use leverage 100%. All it's doing is just adding higher cost and higher risk. It's that simple. And I like as low a risk as possible and as high of a return as possible. It's that simple. And so I did cost per mile, and these cost per day numbers up here are what I did in the last video. So I'll show you on this example. All you need to know to calculate your cost per day is how many miles are you going to run every month, or not miles, how many days are you going to stay out every month on the road, and what are your fixed costs. You take that. So in this example, the total amount was $95.90 before the truck payment. So I'm going to add in $95.90 plus $2,400, which is the truck payment back to yourself. So your real cost per day is $11,990. That's before fuel and maintenance. Okay, divide that by, and I say like 21 days. I did 21 days up here as the example, and I just said, okay, I'm going to do it divided by 21 days. That's your cost per day, $570. So up here, it was $456 in this, using these set of numbers over here. It was $456 without the payment back to yourself. Well, it's $570 before fuel. $570 a day over 21 days. Okay, let's say you do 24 days, and you just play with these numbers. All right, and divide it by 24. $499. So the longer you stay out, of course, the more days you run, the lower your fixed cost. And what I did too in the example of the cost per day video, I did do like an average of 450 miles a day to just illustrate the point of what would your fuel costs a day. So I did that times, or divided by 7 times $3 a gallon. So 450 a day, 7 miles per gallon, or divided, 450 miles a day divided by 7 miles per gallon times $3 per gallon, 192. So I'd take that 192 and add it to the 570 for the 21 days, and that's pretty much your cost. Now this is excluding maintenance, right? And you could add in the 15 cents a mile to that 450 a day. Do 450 times 0.15, multiply that by 21, add it to this 762, right? But moral of the story, let's just say you did add that as the example, because I don't want to take too long. I think most of you understand the point, right? But this would be your cost per day, right? If you stayed out 21 days, and you factor in all your fixed costs, the payment back to yourself, even the fuel costs, you can't take a load that doesn't pay you at least this much per day, right? So if you get a load that pays, goes 2,000 miles, or not 2,000 miles, 1,000 miles, and it pays you $2,000, a lot of guys say, man, that's cheap freight. That's $2,000. Or that's $1,000 a day, but it's only $2 a mile. I want $3 a mile. So I'm going to wait. I'm going to take that, you know, that I'm going to wait for that $3 a mile load, right? But the $2 a mile load only takes 2 days to deliver. It picks up and delivers in 2 days. But that $3 a mile load picks up and delivers in 3 days. You got to wait on it an extra day. Yeah, you're getting more money per mile, but you're not hitting your number that you need to hit every day. You know, cost per day and rate per day matters more than cost per mile and rate per mile. They both matter, but really your cost per day and your rate per day matter more than anything. And that's why I wanted to save the cost per day till the end. Again, I've been very clear about that in other videos. Even when I did my cost per mile video, I explained why cost per mile isn't the most accurate way to do your numbers. It's not. But moral of the story in this video is I'm showing you all of this so that you have a payback plan, so that you understand, hey, I have so many options as to what I could do with my money, right? I could invest it in a business, US Treasuries, real estate, the stock market, whatever. And you just have to invest in one, what you understand. Two, you got to know your risk tolerance. What is your risk tolerance? For me, trucking is, yes, it's risky, of course, but it's not as risky to me as somebody who, doesn't know anything about the industry, doesn't have the education about the industry, just doesn't understand it, and doesn't have the experience. Of course, you're going to be like, man, I would rather just buy an index fund. And that's not a bad idea. If you don't understand business, you don't understand the trucking business or whatever business you're thinking about starting, if you don't truly understand it and have that confidence that you're going to succeed, you're better off buying a lower risk investment. And that's just the way it is. But I do both, man. I don't just invest in trucks, but that's an example, what I just showed you, as to how profitable a trucking business can be, especially if you do what I just said in this video. If you can at least maintain a payment back to yourself, and you don't have to do the discounted rate I did at 10%. Like I said, you could use just the US Treasury rate. You could pay yourself back at 5%, you know, um, and make it a lot easier to pay yourself back, at least get your principal back. But like I said, I do the higher rate because I would have my money invested in a little higher risk investment than just like a US Treasury or a money market. But yeah, that's my video for today, guys. If you want me to do more videos like this, I enjoy talking about stuff like this. But to end the video, if you are going to become a business owner in trucking, or you're going to become a business owner, period, you need to think like an investor. If you're whatever amount of money you plan on investing, you got to think, what are my options with this money, and where can I get the best rate of return for the least amount of risk? And that'll let you know whether you start that business or you don't start that business. It's that simple. So that's my video for today. God bless. Thank you for watching, and peace out.